Coming up on today's show, why stocks are tumbling in today's trade and what higher yields means for your portfolio, and where exactly do things go from bad to worse, especially as we have a budget bill about to make its way to Congress, which calls for widening the deficits. Also, what are the best stocks to buy right now and why this chart matters? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks stumbled on Wednesday as bond yields continue to climb, putting pressure on equities and the market assessed targets earnings. A very red day, a very ugly day for the market. In fact, the only stock that was green right here was Google, and that's because the market actually went and watched the event yesterday after completely ignoring it. Google up 3.2%. Every other sector, every other stock was very, very red. Every single sector was down in the dumps today, with the S&P 500 down 1.62%. Very, very ugly price action. And you can see gold right here, the safe haven up 0.73%, and the second best performing sector being XLP and still down negative 1.15%. Today was really a complete rotation from risk assets into gold, into safe havens. And it was really just gold as the safe haven because what happened in the Treasury bond market, we're going to talk about it. Not very pretty stuff. And you could see it all happened right here around about midday, 1 p.m., 2 p.m. And then things took a turn for the worst. And it was brutal everywhere. Small caps, mid caps, large caps, value core and growth. Everything was red. A complete flight of capital from the US equity market. And it really all stemmed from this. A terrible 20-year bond auction meant the 20-year yield surged to 5.1%. We had the bad bond auction right here. There were no buyers. That is not a pretty sight. And guys, when we look at the 10-year yield, right, the second we get above this 4.5% mark right here, that is where it becomes an issue for sensitive and low quality equities. And above the 5% mark, again, this is the 10-year yield, above the 5% mark is when it broadly becomes an issue for equities at large. So we are in this stage right here. We're going to have to see if Scott Bessent, Trump can ease the mind of the market as well as the Fed. But yeah, this is now officially becoming an issue for the broader market. Another thing that weighed on overall sentiment is actually Target's earnings. Now, its shares were down as much as 7% here, as you can see in early trading, after the company posted earnings results that were weaker than expected and warned of a drag from tariffs. The stock did pair some of these losses because it just trades at 10 times earnings. Now, I did say that you want to wait for this company's earnings and then potentially get in. I don't think this is the right place to get in for Target right now. Looking at United Health, it was down another 5% because it got a downgrade from HSBC on a report that it paid nursing homes to reduce hospital transfers. So more bad news for United Health. This is going to weigh on sentiment. What's going to be great though is we've had this massive move down, then we've had a massive move up, sort of like a dead cat bounce. Now we're getting another pullback, and wherever this pullback resolves, that is likely going to be the low. And if we can form a higher low, the absolute low being about the 260 area, if we can form a higher low above this area, I think that's going to be really, really constructive for United Health to move higher. FICO, Fair Isaac Corporation, was down 15% today, and that's because of what's going on in the FHFA and some of the regulation. Pretty much, the FHFA is saying we're going to bring forth legislation that from now on, creditors and borrowers will only require 2 credit reports instead of 3. So essentially, 1 less FICO score is being pulled. FICO charge per score. So essentially, 33% of their revenue is quite literally going to vanish. Can pricing offset this? Yes, but not in the short term. And that is why the stock was down. Also coupled with the fact that the stock trades at 90 times earnings. And so you're going to see the stock move lower. I wouldn't be surprised if it falls another 10% from these levels. And then Snowflake reported its earnings after the bell. It beat top line and bottom line expectations. The guide was pretty decent, up 2.56% on the day, but at one point it was down 3%. So this is quite the move here in the after hours. We'll see if it holds post the conference call. That being said, very positive price action from the market with regards to Snowflake. And I'm going to cover snowflake in my second channel, FinFluential Media, guys. It's going to be on about 2 to 3 hours after the upload of this video. So go ahead, like and subscribe. Follow me on FinFluential Media at FinFluential Media so you don't miss that earnings report. And if everything we saw today, Brett, was terrible, we have 5,000 decliners, 1,000 advances. We saw net outflows in the New York Stock Exchange and the Nasdaq 100, with the S&P 500 down 1.6%. And market momentum is turning. We lost the 5-day moving average after the move we saw today. The 20 and 50-day continue to hold strong, and we haven't taken these longer-term moving averages. And now this is beginning to look like a red flag. If we start to lose these medium-term averages, the entire market will come under pressure. So guys, looking at the charts, you could see the S&P 500 down 1.61%. Same with the Nasdaq 100, about 1.34%. But what really took it on the chin was higher beta. And that goes to the yield situation. The second yields rise, higher beta, these high growth assets are really going to take it on the chin because they lever up and their cost of capital is generally higher. The RSP fell more than 2%, and it was actually a very, very ugly day for equities as a whole. Looking very mixed here in the after hours, but again, after a massive 20% rally in the S&P 500, this is the type of price action you would expect from these highs. But it looks like the selling was just concentrated here in the US. We could see Europe was flat on the day. China was also flat on the volatility did tick up in a very big way, but the VIX curve still looks very normalized. And you could see right here, the 2-year, 10-year, and 30-year yield gained in a very big way. Bonds fell as a result. The dollar was down nearly 0.5 percentage point, and the market really just positioned itself into risk assets, gold. And we could even see Bitcoin catching a bid, hitting all-time highs. We know why. It's thanks to M2 money supply, but Bitcoin is also a hedge against the monetary system, and a failed bot auction shows there is some issues in that system, and Bitcoin is a way that I believe you prevent that. At least that's what the Bitcoin maxis and Bitcoin bros will tell you. That being said, a very, very clear position into safe havens here, gold and silver. Very, very ugly day for equities as a whole. And if we actually look at the S&P 500, we said that we were looking for some weakness here at this top level at the 5960 area. That's actually the weakness we are getting. And we said that we are looking for support to be found about here, this yellow line. This is called the gamma flip line, the 5780 level. So if we continue to see a red day into the end of the week tomorrow, right? Don't be surprised as long as we hold this level this week, the 5780 level. If we hold that level, we can find support. We can then move higher. If we break this yellow line right here, guys, this gamma flip zone, we're probably going to go ahead and close this gap right here. That is the likely scenario. So we want to see a move to the gamma flip. If we hold, we probably move up from there. So it looks something like that, right? However, if we go ahead and break this yellow line, we probably move lower, right? And then we'll probably target this 5600 area, or at least closing the gap, and that gap level being sort of like the 5682, 5660 area, somewhere around there. But in the here and now, we're looking for the gamma flip to find our support. We did use it as resistance right here, and we used it as resistance on multiple occasions, as you can see right here, and right here. So this is a strong level of support. If we do go below there, things can get ugly for the markets as a whole. That being said, a very similar situation in the Nasdaq 100. We're looking for a pullback to the 20,580 area. Same thing. If we can hold right here, we're going to move up. If we can't, we're going to go ahead and close the gap to the downside. Now, looking at the RTY, the Russell 2000, same play, guys. We're looking for support here at the 2013 level. If we don't get that, we're probably going to move lower to the 1930 level right here. This is a very, very ugly looking candle for the RTY. The S&P 500 as well as the Nasdaq 100 look far more constructed. Let's go ahead and look at the RSP really, really quickly. We haven't closed that gap, but it does look like that gap is going to be closed at the 173 area. Again, this was like a gap down and moved lower. Whereas if you look at the Nasdaq 100, there's actually some price discovery at the top here. It wasn't just a gap down and move lower. We did see some initial buying, especially early on in the morning. Let's quickly look at the 10-year yield. So you could see a gap up and move and a close above this level. It looks like the 10-year yield is officially in an uptrend. We're above the 4.5% mark. This is where it gets crazy for equities. Now, the next absolute key level of support is right here. It's sort of like that 4.8 or the 5% level. Anything above here is where things get very, very scary. But we are in not a good situation as it pertains to yields. And now stocks are probably going to move lower because we need to apply a higher cost of capital and a higher discount rate to all valuations. And that is why equities are falling on this bond auction. So yields not looking good, and that's also coinciding with a weaker dollar. I think the dollar is probably going to continue to find support right here. I do see the dollar actually moving higher into the end of the year, but I wouldn't be surprised if we go ahead and retest these lows first. As you can see, as long as we put in a higher low, it probably does mean the dollar does move higher, but not without some volatility first and foremost. Quickly looking at gold, because of the uncertainty we had with the bond auction, gold is going to move higher. It is that safe haven play, but it's got a lot of work to put in to ensure that we go ahead and continue this uptrend. It needs to go ahead and close above the 34, 37 level. That's like 100 points away. And if we actually take a measured move as to what that would look like, it's still, another 3% move from there. Something that they could do in a day, but still a pretty big move. If we actually see, let's say, a move up and we actually fail, right, and we put in a lower high, then this actually looks sort of like a bear flag where we could actually go ahead possibly to the 3,000 level. Again, I'm not too sure what's going to happen with gold in this situation. What I am more certain of is Bitcoin. Bitcoin continues to track M2 money supply higher. This is Bitcoin right here. This yellow line is global M2 money supply. And when we lag it by 80 to 100 days, it gives us the path forward. We've broken all-time highs. I said to buy here in a very, very big way. It's exactly what's happening. Bitcoin is moving higher, and we probably will continue the surge into early June before we see a massive pullback. That being said, expect Bitcoin to continue to move high, and you could see a money supply hit another all-time high, so that will continue. Now guys, let's talk about sentiment. This is CNN's Fear and Greed Index, and we continue to be in this greed zone right here despite the market price action we've seen over the last couple of days. And this is essentially telling us that if we do get any dips, guys, buy those dips, because when we get into the greed territory and we stay in greed territory, we sort of get that mid-cycle price action where we just keep making higher highs, higher lows, a little bit of consolidation, then higher highs, higher lows. So buy those dips until things materially change in the landscape. And look, even last week's downgrade wasn't able to deter the market. If you thought this was going to be the be-all and end-all, it simply wasn't the case. And while downgrades do increase implied volatility and uncertainty, it certainly hasn't derailed the market as you think it would have in the past. And generally speaking, 12 months later, stocks tend to be higher almost 100% of the time. And amidst all of the uncertainty we have right now, one thing is certain, and that is corporate buybacks. Authorizations are tracking at some of the highest levels ever. Execution's not quite there at the moment. However, what we typically see is looking 12, 18 months ahead, about 95% of authorizations get executed. And I think management teams are just keeping a little bit of dry powder at the moment amidst all of the uncertainty and awaiting market clarity. Once that clarity comes, we should see buybacks, the likes of what we saw here in 2021, 2020. And looking at the macro, guys, now something that everybody's talking about is Donald Trump's one big beautiful bill. And this is the structure of the bill right here. It's very, very interesting. So this right here is increases or spending hikes and tax cuts, essentially increases the deficit of the country. This right here is decreases or tax hikes or spending cuts. And essentially, this component right here funds this. So you could see here that the majority of bill is centered around extending the 2016 TCJA. That's the Tax Cuts and Jobs Act. So they're going to extend those. We're going to keep the corporate tax rate in the mid to high teens. They're also going to raise the standard deduction. They're going to see limits on alternative minimum tax, child tax credits right here, and then other tax changes, as well as defense and border spending. This is all going to be funded by repealing the personal and dependent exemption, a state and local tax deduction cap, that's the SALT Act, SNAP as well, cutting Medicaid by $625 billion per year, tuition and aid cuts as well. However, despite all of this right here, it is simply not enough to make up for the increase in spending. And per year, you should see about a 2.75 trillion deficit per year. So based on where America's fiscal picture is right now, this is not a good sign, all things considered, but it's the path our policymakers have chosen, so we got to run with it. More so in the near term, we could see a little bit of elevated volatility and uncertainty as it comes to potentially a government shutdown. We could see that any extraordinary measures are going to run out about the 30th of June, and the debt limit is likely to be hit around this mid-August time period, as you can see right here, guys. So if this bill doesn't go through, we're looking at a potential government shutdown in that mid-August area. So it's good to see they're actually acting right now. So a lot of uncertainty on the horizon, but I will take it one day at a time. Looking at data for the rest of the week, guys, tomorrow is when it really kicks off here on Thursday. We get the initial jobless claims. That's probably a minor data point. We're looking at 231,000 there. Then we get the composite PMI, which is made up of the manufacturing and services PMI. We're all looking for a 50 level right there. This is going to be particularly key as it pertains to the health of the economy, because it is the May data, as you guys can see right there. And then we also get existing home sales, but this is still the April data. So we're looking for a year-over-year rate of 3.9 million and a negative 3% month over month. Tomorrow, the biggest names are reporting after the close. Intuit, Workday, Autodesk, and Deckers Outdoors are all reporting after the close. Some heavy hitters in their sectors. And before the open, it's Williams Sonoma, American Auto Parts. We've got Toronto, Dominion Bank, I believe Analog Devices as well. But they aren't the market movers as some of these names in their relevant sectors. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.